Welcome to Iron Financial. This is the show where we forge stronger portfolios, and we do it by cutting right through the market weakness. I'm your lead analyst, and today, we are not just looking at another stock. Oh no, we are inspecting a structure. We're going to take our tools to Abercrombie Fitch's latest earnings report and see if this company is actually built to last or if it's just a teardown waiting to happen. You know, the headline numbers, they look solid, but our job here is to stress test the entire framework and see what the rest of the market might be missing. We're going deep, way beyond the press release fluff, to give you the actionable intelligence you need to make smarter decisions with your capital. And I'm your market skeptic. Look, the question for today is really simple. We're seeing all these headlines about record sales. The stocks had an absolutely monster run. But what are we really buying into here? Is this a fortress with a deep moat and a solid foundation? Or is management just slapping a fresh coat of paint on an old, rickety building with some very serious structural issues? The market loves a good comeback story, I get it, but my job is to ask if this is a genuine turnaround built on sound fundamentals, or is it just a temporary fix that's been fueled by hype? We're here to figure out if this is a truly solid investment structure or just a costly renovation project in disguise. So let's get to work. Okay, let's dive right into this. The entire story of Abercrombie & Fitch right now is really one of conflict. I mean, it's a contradiction that you can see plain as day right in their top-line numbers. On one hand, you've got the company as a whole, and it seems to be firing on all cylinders, posting some really incredible results. But on the other hand, the very brand that gives the company its name, well, it's getting left in the dust. And this is the central tension that we have to unpack. Because everything else, we're talking profitability, we're talking guidance, we're talking valuation, it all stems from understanding this one core conflict. This is the essential crack in the wall that we need to investigate first. Now, what's so interesting about this slide is the puzzle it presents. Just look at the left side here. The parent company, ANF, is celebrating, and they should be. Record full-year sales hitting over $5.3 billion. That's a 6% jump from the year before. I mean, that is a solid, impressive number in any retail environment, let alone this one. But then your eyes drift over to the right side, to the flagship brand, the name on the door, Abercrombie. And sales there actually went backward, a 1% decline for the full year. So the very first question we have to ask is fundamental. How can a company be hitting all-time records when its namesake brand is actually shrinking? That just doesn't feel like a solid, unified structure. It feels like one part of the building is pulling all the weight, while the other part is just sagging. Exactly. And before we go any further up this structure, we have to check the foundation. I mean, any smart builder or any smart investor knows that a weak foundation will bring the whole thing crashing down, and doesn't matter how good the upper floors look. For a company, that foundation is the balance sheet. It tells us everything about their stability, their ability to withstand a storm, and whether they really have the resources to fix problems or invest in future growth. So let's grab our hard hats and go inspect the concrete and rebar of ANF's financial health. So the first thing we see is a massive pile of materials just ready to be deployed. $760 million in cash and equivalents. Now, this is absolutely crucial. In a tough retail environment like we have today, cash isn't just king, it's the entire kingdom. It provides flexibility, it pays for your inventory, it funds your marketing campaigns, and most importantly, it protects the business against any unexpected downturns. Having this much cash on hand, it tells me the basic foundation here is thick. They are not in any immediate danger, and they have the capital they need to maneuver. This is not a company that's struggling to make payroll. This is a company that's armed for opportunity. And the foundation gets even stronger from there. When you add their available borrowing capacity to that big pile of cash, you get to a total liquidity of $1.2 billion. This is their war chest. This is the financial bedrock of the company. From a structural standpoint, this is a huge green flag. It means they have immense stability. They can weather economic shocks, they can aggressively invest in their brands if they want to, and they can return capital to shareholders without even breaking a sweat. So the foundation itself, well, based on these numbers, it looks rock solid. Whoa, hold on a minute. The foundation looks solid from a distance, I'll give you that, but when you get up close, you start to see some of these little hairline cracks. This quote right here from Guru Focus, this is a big one. Think about it. If the architects of this building are so confident in its structure, why are they selling off their personal stakes? We're not talking about one person. We're talking 4 different insider selling transactions, offloading 400,000 shares in just the last 3 months. Now look, insiders can sell for many reasons, diversification, buying a house, whatever. But when you see a pattern of selling against a backdrop of seemingly great news, that is a cautionary signal. It's the first red flag that makes me question if the people on the inside know something about this building's integrity that we don't. That's a fair point, and it's one we'll keep in mind as we move up. So now we're moving from the foundation up into the engine room. Where is the power for this company actually coming from? We already know there's this big disconnect between the company's total growth and the Abercrombie brand's decline. So if Abercrombie isn't driving the growth, who is? We need to isolate this growth engine to see just how powerful it is, and maybe, more importantly, how sustainable it is. Is this a twin-engine jet that's flying smoothly? Or is one engine completely out and the other is just running on maximum overdrive, risking a burnout? And this slide, well, it lays it all out in black and white. The numbers just don't lie. Look at the data for the full fiscal year. The Abercrombie brand family, they brought in about $2.52 billion, which is actually down from $2.56 billion the prior year. That's a negative 1% change. Meanwhile, you've got the Hollister brand family, and it's an absolute monster. It jumped from $2.39 billion all the way to $2.74 billion. That is a 15% surge in sales year over year. Hollister isn't just growing, it's exploding, and it has now officially surpassed the Abercrombie brand in total sales, making it the true centerpiece of this company. The visual contrast here is just stark. You simply can't ignore it. Hollister is doing all of the heavy lifting. That 15% growth is what is carrying the entire company's 6% top-line growth. Without Hollister, let's be honest, this isn't a growth story at all. It's a story of stagnation and decline. The Abercrombie brand is acting like a drag. It's an anchor on the company's overall performance. So when you hear management talking about their two globally relevant brands, well, the data right here suggests that one is far, far more relevant to the company's growth trajectory right now than the other. And that heavy lifting, it might be getting even heavier. This right here is a deeply concerning signal. Same-store sales, you might hear it called comparable sales. It's a critical metric in retail. It strips out the impact of opening new stores or closing old ones to tell you how much growth you're getting from your existing locations. It's really a pure measure of the organic health of the business. And for ANF, that number slowed down to just 1% in the critical fourth quarter. 1%. After seeing double-digit growth in previous quarters, a sudden slam on the brakes like this suggests the overall momentum is fading, and it's fading fast. This is another one of those cracks that's starting to appear in the facade. That deceleration is a critical data point, and it leads us directly to our next inspection point, the load-bearing walls. You see, sales are one thing, but profitability is what holds the entire structure up over the long term. Are they building a profitable enterprise, or are they just chasing revenue at any cost? We need to look at the margins. This tells us about the company's efficiency, its pricing power, and ultimately, how much of that revenue actually turns into real profit. This is where we check for signs of stress and compression on the business. Okay, so the headline number for the full year is an operating margin of 13.3%. Now, for a retailer, that is a very strong number. Make no mistake about it. The company's press release correctly points out that this is their third straight year of double-digit operating margins, which is a significant achievement in this sector. So on the surface, this looks incredibly healthy. It suggests they have strong control over their operations and they can generate significant profit from their sales. It's a key pillar of the bull case for this company, for sure. But again, the headline number doesn't tell the whole story. The crucial point here is the trend. Yes, 13.3% is good, but it's not as good as the 15% they posted the year before. That's a significant drop of 170 basis points. The load-bearing walls are holding, but they are clearly under more pressure than they were just a year ago. Profitability is being compressed. So the question becomes, is this just a one-time blip caused by some temporary headwinds, or is this the beginning of a dangerous trend? Is the structure weakening under the strain? And the income statement pinpoints the exact source of that pressure. I want you to look closely at this document with me. Find the line item for cost of sales. A year ago, it took about 35.8 cents of every dollar in revenue to produce and acquire their goods. This year, that number jumped to 38.5 cents. That nearly 3% increase is exactly where the margin compression is coming from. It's simply costing them more to sell their clothes. Whether that's higher input costs or more promotions to move inventory, or even just a change in product mix, the result is the same: less profit for every single dollar of sales. So we've seen a solid foundation, albeit with some questions. We've seen a powerful engine that's doing all the work, and we've seen some clear signs of stress on the profitability walls. Now we need to look at the blueprints. What is management planning for the future? Their guidance for the upcoming fiscal year, it tells us exactly where they think this project is headed. Are they planning to reinforce the structure, or are they bracing for more pressure? Let's see what they're telling the street. All right, here they are, the blueprints management has laid out for us. For the full fiscal year 2026, they are guiding for net sales growth between 3 and 5%. And that's a slowdown from the 6% they just posted. They expect operating margin to land somewhere between 12 and 12.5%. And finally, earnings per share are projected in a range of $10.20 to $11. These are the key metrics to watch. These are the targets management has committed to hitting. And there it is. The blueprints confirm our fears. That drop in operating margin wasn't just a one-time issue. They went from 15% down to 13.3%, and now they are telling us to expect another drop to around 12.25% at the midpoint. This is a clear, undeniable trend of margin decay. The profitability of this business is eroding. Management is essentially drawing up a plan that shows the walls will be under even more stress next year. And that is a major red flag for the long-term structural integrity of this entire investment. However, the blueprints do show that management is installing a major reinforcement beam to support the structure. They are planning another massive $450 million in share repurchases for the upcoming year. Now, this is significant. It's a direct return of capital to shareholders and a very powerful signal of management's confidence in the company's value. Buying back stock reduces the share count, which directly boosts earnings per share and supports the stock price. So even as those operating margins compress, this aggressive buyback program is a major tool they're using to build shareholder value. Okay, the inspection is complete. We've checked the foundation, we've stress-tested the engine, we've examined the load-bearing walls, and we've reviewed the blueprints for the future. We've seen signs of immense strength and some clear, undeniable cracks. So, what's the final verdict here? Is Abercrombie Fitch a solid investment opportunity, a structure that's built to withstand the test of time? Or is it a value trap, looking good on the outside but hiding critical weaknesses deep within? Let's break down the bull and the bear cases. The bull case is that this building is structurally sound, period. You cannot ignore the record-breaking company-wide sales growth of 6%. The engine, Hollister, is a genuine powerhouse, growing sales by a massive 15% year over year. The foundation is absolutely fortified, with over $1 billion in total liquidity, giving them incredible financial strength and flexibility in what is a very volatile market. And management is absolutely committed to returning that value to shareholders through aggressive, large-scale share buybacks. The argument is that these core strengths are more than enough to overcome any of the minor issues. The core structure here is solid steel. But the bear case sees those issues not as minor, but as major red flags. The flagship Abercrombie brand, the actual name of the company, is actively shrinking. That's a serious identity crisis. Profitability is clearly cracking, with operating margins falling all the way from 15% down to 13.3%. And the company's own blueprints, their own forecast, points to even more decay, guiding for margins to fall further still. You add in the cautionary signals from insiders who seem to be heading for the exits, and the picture looks much more precarious. This isn't a solid structure. It's a building with a failing component, buckling under pressure, with the architects quietly cashing out. So here is the bottom line. Is ANF a financial fortress built on a solid foundation of cash and powered by the undeniable strength of the Hollister brand? Or is it merely a facade where record numbers are hiding the decay of its namesake brand and cracking profitability? It's a structure that is heavily, perhaps even dangerously, reliant on a single engine. And that is the question you have to answer before you put your capital on the line. Thanks for joining us on Iron Financial. We'll see you on the next teardown.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.